Hello, everyone. Welcome to the weekly roundup. Today we will cover macroeconomic updates, tech, and market sentiments. Hello, Ben.
Hey, Eva.
How's it going?
It's going great.
The weather seems nice.
Yeah, it's getting better. It's good. The groundhog told us spring's coming.
Spring's coming. I'm holding on to that.
Me too. We need
Yeah,
something.
January was brutal.
So cold, I can't remember a winter like this.
Oh,
Yeah,
we need the sun.
for sure.
Okay, let's get into it. So, recent economic data, retail sales, unemployment, PMI, have been coming in softer and pointing towards, weaker forward guidance. How could this influence central banks' rate decisions in the coming months?
Yeah, thanks. I think that's a good place to start. It should have an impact on them, but the data is so choppy, and we had new jobs numbers come out in the U.S. this morning, and they said they beat expectations, but they had a 50,000 job downward revision to December. So, there's no doubt about it that employment is getting softer and the quits numbers falling, which is people looking for new jobs. I'd say the income earning potential pressing lower as well. So, I think it will have an impact. A lot of the things I think going on too probably are going to wait to Marsh comes in. I saw Trump this week. You may have as well. He said, I made a mistake hiring that guy. He hasn't even started in the job yet. Um, anyways, I think it'll have an impact, but some of it's probably going to be more loaded mid-year, later in the year, because the government's still catching up from a shutdown and the data is still coming out slower than expected. But, the economy is slowing. Q4 for the US showed that the economy expanded slower than expected. So, um, I think it has an impact. I think the market's still underpriced it, based on my comments the last few weeks. So I think we'd still see interest rate cuts and the central banks expand their balance sheets. So buy assets, keep yields lower.
Okay, so digging into the jobs picture just for a moment, we know employment is cooling, wage growth appears to be going nowhere. At what point will this actually start to matter for the market?
Maybe never. I think that it should matter, and I think it probably does, and it'll have an impact more on the what the central banks do as opposed to how the market interprets it. And so, I think we have this cycle's been extended based on a lot of things that the governments have done, both from how they manage their duration in bonds and both from how how soft their interest rate stance is. So all these things should matter to the markets. But I think what's mattering more right now is money supply, and I think from a market perspective, that's a big driver to what happens here as opposed to the economic data. So the economic data, I think, will drive the central bank and the governments, but the markets will move and ebb and flow based much more on money supply. And we're starting to see that tick up. And so I think that they are to some extent decoupled, still important and important to watch together, but they're a little bit decoupled from reference to where the levels of markets are versus what the economy is doing.
Okay. So my last question is definitely going to be in the tech space. Lots going on in AI. What should investors be watching out for? Is AI a true long-term growth story, or has it become sentiment-driven trading?
It's a great question, and I try to think about there's so many layers to it. And so, we saw something that we follow for a while, which we saw Thomson Reuters, who is a big provider of research. They provide our quotes and news feeds, and they have a division that is their legal AI, which they sell to or generate revenue from governments, and governments use their legal AI to source data and information they need to support their cases. And so Thomson's a big leader in that space. But what happened last week is Claude, which is owned by Anthropic, Claude AI, launched Claude 4.6. I don't know. It's one of their launches, and that seem to indicate that some of these AIs are disrupting or potentially disrupting industries faster than expected and or anticipated. Um, I haven't used it extensively yet, but from what I've read and followed around how this particular one works is you integrate it into your system and it runs as kind of a partner on everything that you do and helps augment your kind of your thinking around how you use the systems. From somebody I followed in finance, portfolio manager that uses and have used Bloomberg forever. They wanted to see if they could replicate what Bloomberg does. And within a span of about 6 hours, with the help of Claude, they replicated what they use on Bloomberg, which, they pay Bloomberg $5,000 a
It's
month for
crazy.
this, and they replicated it. So it's coming fast.
Yeah,
It's moving quickly. I think as you peel back, like Anthropic is owned by the big techs. So the big tech companies. So Anthropic is owned by, believe, Amazon's the biggest shareholder, NVIDIA, Google, Apple as well as an investor. And then if we look obviously at ChatGPT, which is OpenAI, the biggest shareholder of OpenAI is Microsoft. NVIDIA is also part of that. So I know that's not a direct answer to your question, but all the big companies are integrated and seem to be the backbone of the present version of AI, but the speed that it's being rolled out at is very fast. There's a risk that it disrupts industries because the big companies aren't adapting quick enough, that's for sure. And they aren't allowing AI integration to a lot of their systems. So I think it's very disruptive. Is it going to be better for companies? Is it going to drive profitability? I think the answer is yes, and probably faster than we think. And so right now, the more nimble businesses are able to use and integrate AI into the system, better, you know, processes, systems, building, you can build at scale very quickly probably allows you to shrink the employment base. And so I think that's having an impact on the jobs numbers right now and likely drives profitability, not immediately, as we saw Google came out with their numbers and they said they were spending more than the market was going to anticipate in AI. So some of this is going to be front loaded, which will result in more profitability down the road. And historically, when the big tech companies have put massive investments, market doesn't like it initially, but then a quarter, two, three down the road, they tend to see that flow down to the bottom line. And I think that'll still be the case. So yeah, I think it's here to stay. Are some of the valuations overextended for sure? Are some of these businesses like hopes and dreams? Definitely, but the big ones, they're taking two-pronged approaches, invest in these big startups that are growing quickly, also to help our bottom line down the road. So I think it is here to stay. Valuation wise, you can argue that, but yeah, it's incredible at how quickly it's moving right now.
maybe we stop using our brains at some point.
Yeah,
Yeah, let's see the charts. Yeah.
that seems to be the one that people are worried about.
Yes.
Yeah.
Okay.
All right, good to go. Okay, so we are recording this a day early. So it is Wednesday, February 11th at 1 p.m. So anything that happens between now and next Thursday, we'll provide an update on. But there are a couple charts here that I wanted to go through with the current update. So we'll start with the stock bond barometer standard deviation. So this is from our partners at Argus Investments. And so Argus is one of the US research providers, and they give an update on stocks versus bonds. Should you own one over the other? And I think it's an interesting way to think about things. And there's so many different inputs. This is great from a perspective as this chart goes back to 1960. So you've gone through multiple cycles. And the cool thing that you can see within here, if you go through the major cycles anyways, the bottoms in markets, which are these numbers, which is when markets bottom, it favors stocks. So that means that you'd want to sell bonds and buy stocks. And when markets peak, you want to buy stocks, or so buy bonds and sell stocks at these different peaks. So now we've been focused and been kind of stuck in this band here where it's been less pronounced as we've seen maybe in the past. And so I think that's an interesting point where you kind of get stuck on maybe we'll just own stocks because they do better over the long term. Their proprietary model is starting to say that bonds actually are starting to offer better value versus stocks based on the historical levels that they look at. And it still makes sense to have bonds within portfolios. And probably more than ever, it makes sense to reduce some of your stock positions and maybe buy bonds because yields are reasonable. I know, Eva, we looked at it today where, 25-year bonds, you can lock in 5.5%, with double A or triple A investments that can give you 5.5% for the foreseeable future. That's a pretty good yield. And so the metric is saying, let's look to own it and own some bonds within portfolios because they're starting to look attractive. Next one is the 10-year government bond charts, Norway versus Germany. And so this was a great piece from our capital economics partners. And so they give an update just around what's going on. We saw yields blow out in Norway yesterday. A bit of a surprise. There was maybe some fear that rates are going to take off. In some of the other European countries, we saw Australia's yields rally because the central bank in Australia raised rates. And so this was Norway yesterday. So Norway rates popped up, and then Germany actually moved down into this backdrop. So, maybe we're starting to enter a period where it does matter, and it is much more important to have an active management within the different structure. You can't just buy passive and that everything's going to move in the same direction together. And we're starting to see a bit of a decoupling of the world where there is, some countries are starting to go in another direction, raise rates, fiscal changes, monetary changes, while others continue on the path of forward, which is rates lower. And in this case, this would apply where Germany, no change, actually slightly falling as money flowed into German euro bonds and actually push rates down a little bit on the 10-year. Last one, global interest rates and inflation. So this is also from Argus. And so this is a look at the 10-year government bond yield. So that would be the red bar in this chart here. And along the bottom here is actual percentage yield. So the 10-year and the consumer price index is the blue bar. And so I think this is interesting and worth looking at, paying attention to. So this is Russia. So not that this is an investable asset class, which we've talked about for some time, around 14% on their 10-year bond yield, where inflation's around 6.5 right now. Brazil, you get paid around 14% on the 10-year. Inflation's down around 4.5, 5. Mexico at something around 8.5, 9%, and their inflation's down around 4. If you look again, so then India 5. So I think it's interesting just to think about it. The only place where we're seeing the inverse of that is Japan. And I've talked for some time that I think Japan is going to play a major role here. And so you actually have inflation or CPI just above the 10-year. And so there is some fear that the 10-year bond in Japan is going to continue to go up because of this inflation influx they're having. My view that's not the case, but as I've mentioned multiple times, India I think is attractive. They have really high yields and CPI is quite low. So I think that India is an attractive area both from an investment in bond land, but also from an investment in equities. I think the biggest risk challenge is the market is still closed. Once they open up, I think that's when the opportunity really realizes. So I don't know if that's 3 months from now, 6 months, or 2 years. I just think that that's a great risk reward opportunity at this point. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. Everyone has their own risk tolerance and may not apply some of these investments to you. Should you have any questions at any point as well, please feel free to reach out to Eva or I, and happy to address if any of these things are suitable for you. That's it on the charts.
Oh, I was muted.
Okay.
Thank you. What's on the agenda for this week, for next week?
Yeah, so I think, the markets have definitely been chopping around for the last 2, 3 weeks. And so I'd look at the volatility of the different things, and market volatility is actually quite muted given the chop that we've seen. Gold volatility is still a bit elevated, so I'd be looking at that. As the volatility comes back down in gold and silver, that'll be interesting to see if that market can find a base here. And so I'd be watching that input. And the last is obviously bond volatility, which is the move index. And so I'd kind of be watching those things to see if there's any signs that there's something more material happening. Went through the gold silver sell off and volatility blew out, and some companies probably left the business in that space. And so we're seeing that start to calm down right now. So I'd be watching those levels. The last piece is obviously oil because it seems like it's taken off a little bit here, oil and natural gas. And so increasing oil prices right now tend to signal that the economy is starting to expand. So I'd be watching that as well and to see if that's the case. And the U.S. energy minister is in Venezuela this week and into early next week probably. So we may get some feedback around when they can start to put production back in and increase production, and the level of the of upkeep in the Venezuelan oil fields would be interesting. So I'll be watching those things next week.
Yeah, quite a bit to look out for next week.
Yep.
Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video. And once again, if you missed our annual outlook last week, 2 weeks ago, please go to our YouTube page. The playback is there. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and enjoy the rest of your day. Bye.
Thanks, everybody. Bye.